before we talk about average, and I asked you this kind of on the spot yesterday at the end of the hour, but if you think about FIFO, it stands for first in, first out. It's not necessarily the products, but it's, I mean, I think we're getting hung up on the whole, it's not the stuff, it's the cost. The stuff has to go for there to be a cost. Okay, so yes, the stuff is going to, but it's finally assigning, especially in times of rising prices where you see as you progress through it gets a little bit more expensive, which cost are we assigning? And under FIFO, we are assigning the first or the earliest cost or the oldest costs. The more expensive stuff is costs are still here, and all of the reverse is true with LIFO. We are, under LIFO, we are assessing the newest or most recent costs. The old costs really never get touched. What part of it feels backwards? So let's talk, yes, okay. So as we start in that bottom left corner, we first have to calculate the stuff still here to get at the stuff that's sold. So under FIFO, you start with more recent prices, so you can then calculate what's truly gone. So there's one little element where it feels backwards for just the time being. Average cost, it doesn't matter. It doesn't matter if stuff was, well, I don't have our old costs, but if something was 100 and then 110 and 120, you jumble it all together and take an average. This will make the most sense. You simply take a look at all of the unit costs and average them to take a look at the costs available, what was still here and sold. Gotta click over here, hang on. How you do this? You take your cost, I'll go back here. You take your total cost, divide by your total units available. So it's all based on the available. Take total cost available, divided by your total units. On average, 10 plus 11 plus 12 plus 13 divided by, on average, 12 bucks. I think you can appreciate how easy this becomes after you've done the hard stuff. So you take your cost available divided by units available equals average cost. These numbers are, it's been a while since we've talked about this. In this example from the lecture, there was 450 still here, 350 were sold. This is the shush side. So you take 450 times 12, cost of the stuff still here. Then you still run the cost available minus cost shush equals cost of goods sold. And it's that easy. Doesn't this make the most like logical sense? But a lot of businesses use FIFO or LIFO. One of my best friends is a buyer for Medtronic. What is Medtronic? Have you heard of Medtronic? They're usually one of the big sponsors of the Twin Cities Marathon. Medtronic specializes in like heart devices, so like pacemakers, different heart technologies, and yes, I think so. I think the historical background of it. But one of my best friends, this is what she does. She's one of the buyers for Medtronic, and she is constantly looking at FIFO, LIFO, and average. That's part of her job. Because you sell those apparatuses to hospitals and patients, and the costs are always changing. Yes, Bradley. 2 slides from now, we're going to analyze all that. Yes, so you're just 2 slides ahead of me. This visually shows stuff, so we'll get to Bradley's question in a minute. This visually shows it. It's not like liquid-based businesses like a gasoline company or an oil company are the types, but can't you visualize this as like a gas tank? You know, when I go buy gas today after school, it's not like I'm buying the $10 gas, okay? Or the $11. What are our prices here? 10, 11, 12, 13. It's not like I'm buying that at the first, or the oldest, or the newest. It all visually or physically blends together, and it just makes the most sense this way. So what Bradley's talking about, do you guys have this table in your notes? Sweet. This is a whole lot of words, but this takes and numbers and line items, but this breaks down what Bradley just asked. So this is a class of, a categorized income statement. I'm not saying the word right. There's the classified balance sheet and multi-step. This is the multi-step because it's sales plus purchases minus cost of goods sold minus what's left equals cost of goods sold. So this is like a snapshot of revenue and expenses, okay? If you take a look at net income, and primarily like this row here, what we bring in and what's still around, and then all the expenses, la-di-da-di-da. Why we see such a small amount under LIFO is because in times of rising prices like what we've got going on here, 10, 11, 12, $13, if we're selling stuff and recognizing the cost of the higher prices, we're not going to make as much money on paper. And what that's going to do, if we start here, and this is what we get to keep in our pocket, that's a pretty small amount of money, but then from a taxation perspective, you're not paying as much as a business on taxes on a small amount of money like that. LIFO or FIFO would be, of course, the highest because we are selling our cheap, selling at cheap costs. So we're like looking like we're making more money, whereas here we are selling at more expensive costs, driving our net income down. And then, of course, average is always going to be a split, not a split, but in the middle. You see that from an analytics standpoint? To answer Bradley's question, what are some examples of businesses? I don't know. I mean, it's kind of a horse apiece. Don't you want to make a lot of money? But then you don't want to get kicked from behind and have to pay a lot of taxes on that. You know, or you hear of people now, at the end of 2018 buying more stuff for their business to drive their net income down so they don't have to pay as many taxes or there's more tax write-offs available. So that's kind of the behind the scenes look at the analytics. In times of rising prices, LIFO will result in the smallest net income because you are selling expensive stuff or selling stuff recognizing expensive costs. That's the answer to your essay question. Oh, that got your attention. And no, I'm not going to repeat that. Kenzie. Mid-year, I think it's kind of a racket because let's go back to one of the first questions Riley asked. Okay, so shirts at Inherit, are they doing this by type of shirt, size of shirt? So then if you are assuming, again, hence the word assumption, assuming, say, LIFO or FIFO on your shirts, Do you see if it's by size and you've got a like a LIFO or FIFO breakdown on that, how cumbersome that would be to switch that mid-year? I don't know the answer to that question. I think you as the business can do whatever you want. I still didn't give Bradley examples of businesses. Maybe I should assign that to you as your 5 points on our 2-hour late start when I don't see you tomorrow. I don't know. Let's put that on hold. Kenzie, I interrupted you. Sorry. I think a mid-year thing would be hard. Could you switch it at, I should get my friend on the phone. Yes, that would be an example, like major economic shifts. But those don't seem to be like, it's still a roller coaster, but it's kind of gradual. I mean, you're not going to see a like cliff dive in the economy. You'll see a roller coaster. Those are good questions. As soon as when you're working, I will do a bit of Google searching. To me, and I think you all kind of went the same thing, like weighted average is just kind of, it's safe, it's in the middle, it's not extreme on either side, it's just in it, and it's a little bit easier to calculate. Maybe this answers our question. Hang on here. Method should be used consistently, enhances comparability. Although consistency is preferred, a company can change its inventory costing method. I just think it's cumbersome. Here's a little quiz question before we get into the end of chapter stuff. What's the